There are 567 different Social Security claiming strategies. Do you know which one is best for you? I've been doing numbers of videos and received hundreds of questions, and I wanted to share with you the 5 most important questions I've received and to give you information so that you make sure you don't lose out on tens, if not possibly hundreds of thousands of dollars of Social Security income for your household over your lifetime. Hi, I'm Mark Singer, and for information up to date, timely on Social Security, retirement income, make sure to subscribe to our channel and hit the notification bell so you're alerted to when we post new videos. Since we started this channel, I've been very fortunate to have the opportunity to speak to so many of you to help you to understand which decisions to make, because oftentimes Social Security is an irrevocable decision. And if you do it at the wrong time or with the wrong intent or don't properly plan, it could cost you a lot of money. So what I've done here is something I've not done before, which is to choose 5 of those questions that I think are the most crucial and to provide for you some of the answers to that. And the very first question that I do get now is, will Social Security be there for me, and in what form? So here I would like to provide you with the answer that we gave on one of the videos most recently. Social Security is the economic foundation for millions of Americans, whether they are retired, disabled, family of retirees, survivors of families. There are over 169 million individuals who are paying into the Social Security system at this point in time, with about 60 million who are receiving benefits. 1 in 4 American families receives benefits from Social Security. Social Security is basically a pay-as-you-go program. So for those who are currently working, they are paying into the program. And for those who are retired or disabled, they are receiving income as beneficiaries. For our purposes, we are going to be focusing on Social Security for those who are or will be retired. Now that you know basically what Social Security is, I want to address one of the big questions people have, which is the system going broke? For that, let me share with you my screen. So before we get into some of the numbers, let's have a little history lesson. Social Security was created in 1935. At that time, there were 3 times as many workers as there were for those who were retired. That trend is obviously switching, where there are now many more retirees, with 10,000 every day are turning age 62. Also, the life expectancy back in 1935 was 61 years old, whereas today it's now 79. So you can see from now, many years later, again, it's a pay-as-you-go system. There are more people taking money out of the system now than there were before, and we're living longer. So in essence, it becomes a math problem. If you take a look at the OASDI numbers, and what does that stand for? Old Age Survivor Disability Insurance Program. You can see that basically there is the same amount of money at the end of 2017 as there was in 2018. In essence, we're at pretty much a break even. But as we go to the next slide, you will see here that the long-term projections are such that it's about 79% of the guaranteed benefits will be able to be paid out in the year 2034. This was a part of the annual report that came out this year. So assuming that we do absolutely nothing, then this is what will happen. However, we are taking a look at, or I should say Congress is taking a look at, a number of different initiatives to make changes to the system as they did back in the 1980s. So it really isn't going to take a lot to make significant changes to the system and bolster the numbers for the future. What we see here is that we believe that the baby boomers, the bottom line is really nothing to be worried about at this time. Now, the second question I get, and it could be the most impactful one, because if you make this mistake, it could be very, very costly. So you can collect Social Security as early as 62, but should you? And from what I've seen in terms of feedback on my channel, it is the most viewed question that we have. So I wanted to share with you some of that information so that you don't make this potentially very costly mistake. A recent study was published by United Income that indicated that Americans lose trillions claiming Social Security at the wrong time. Here were the conclusions of that study for claiming benefits at the wrong time. The study concluded that 96% of retirees choose the wrong year to tap into Social Security. The people are pretty much doing the opposite of what they should be doing. And that most people are better off waiting until 70 to claim, and 43% of adults actually are better off claiming before 70. So the conclusion was it's not necessarily age 70 that is the maximum. Depending upon your circumstance, it may be earlier, but I would submit to you that you will need to reframe how you think about age 62, that just because you can claim doesn't mean you should claim. As you can see here, the big takeaway was by claiming at the right time, more than half of retirees would see income in their 70s and 80s rose by more than 25%, again, when claiming at the right time. Now, as you can see here in this slide, and I understand that once you're 62, you want to collect those checks, and you assume that if you collect them for a longer period of time, you're better off. Unfortunately, that's not the case. As you can see here, and this assumes a $2,800 primary insurance amount, which is the amount you would get at full retirement age. If you start collecting at age 62, and your PIA at full retirement age was $2,800, the benefit without cost of living would be reduced by 30%. It would go down to $1,960. I call this the penalty phase, because you're getting penalized for taking it early. Early is not a good thing here. Early is a negative. However, if you waited till, let's assume your full retirement age here in this scenario is 67, you get your full $2,800, and then assuming you get the inflation adjustments, your 1960 is moved up to over $3,100. And if you wait till age 70, it's over $4,200. Those are big numbers and big differences. So you really need to reframe and rethink that just because you can get your benefit at age 62, that you should. So let's resume talking about age 62 filing and why you should really be thinking about that. So let's break through the number one myth that I believe people think about is, again, which is I'm 62, I want to collect the money now. I want to collect it for as long as possible. I want to get as many checks as I can. For some, this may be okay. And again, about 1/3 of you do claim at age 62 just because you can. So the question really becomes about break even, what we call the break even analysis. And we have 7 different calculators, and we've run these in many different ways for many different individuals. The reality is, and there's many different factors involved in whether there's a health situation or some financial situation that impacts it, but just assume, a normal health scenario, we're expecting to live to average life expectancies, that if you took your benefits at age 62 versus your full retirement age, 66 or 67, all you have to do is live for another 13 to 15 years. So if you took it at 62, for instance, your break-even point may be somewhere in the vicinity of 75, 76. So if, in other words, if you live longer than being just 76 or 77 years old, you would have been better off to have taken it at full retirement age. It works the same way versus waiting till you're age 70. So it's really important to understand that if you do expect to have a normal life expectancy, and gee, if you even live longer than that, you're much better off to reframe how you think about this, that you may be collecting more checks earlier, but you're going to be collecting them at a lower rate later, as the chart indicated. We're going to have much more money available to us in our late 70s and 80s if we wait till at least full retirement, if not age 70, than starting at age 62. I really hope that that was helpful to you, and that for most of you, as you've seen, you're much better off to push it out from age 62 to at least full retirement age, if not age 70. And there are 567 different strategies. So if you're interested in taking a little bit more time, we've put together a special masterclass for you to answer the questions that you have with regards to Social Security and retirement planning. So if you have the time, click on the link below. The next question that I get is with regards to maximization of spousal benefits. And this has been an interesting year in that one of those strategies, the restricted application, which would allow for deferral of your benefits while they continue to get delayed credits, really expires at the end of this year. So we've eliminated one of those 567 strategies, but this next few minutes will help to answer the question for you if you're married with regards to how to maximize the spousal benefit. So the spousal benefit equals 1/2 the primary worker's PIA if started at full retirement age. Now, a little bit of a history lesson. Back in 1935, when Social Security was born, if you recall, most of the people who were working were men at the time, and women were at home. But it was decided that even if she was at home, she should be eligible for at least part of a Social Security benefit, even if she didn't have the 40 quarters or a full working record. So this is where they came up with spousal benefits. So again, the spousal benefit equals 1/2 the primary worker's PIA if started at full retirement age. So for example, John's PIA is $2,000. Jane, if she had worked part-time, let's say, is eligible for $800. If Jane applies at full retirement age, her benefit will be $1,000, not the $800. So it's important to recognize that you have the ability to do the spousal benefit, and you can claim either off of your work record or off of your spouse's. Now, the rules for spousal benefits are that the primary worker must have filed for benefits, the spouse must be at least 62 for a reduced benefit or full retirement age for a full benefit, and there are no delayed credits allowed on spousal benefits after full retirement age. Now, we recognize that not all marriages work out. The odds tell us that. So it's important just to acknowledge the fact that there is also a divorced spouse benefit. And these rules are the same as spousal benefits. If the marriage lasted 10 years or more, the person receiving divorced spouse benefit is currently unmarried, the ex-spouse is at least 62, and if the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits. Now, what's interesting is on this next slide is that you can have more than one ex-spouse receive benefits on the same worker's records. Johnny Carson was married 4 times. Larry King 8 times. So any one of those spouses could collect their full divorced spouse benefit, and it would have no impact on any of the other spouses or the husband, the ex-spouse, would have no impact on any of those individuals. The next question, or the fourth question that I get a lot, is with regards to what if I collect Social Security prior to my full retirement age? We really have to, when we think about retirement, think about income and taxes. So this will give you some insight into terms of what you should or should not be doing with regards to collecting your Social Security benefit before your full retirement age. The second big pitfall to avoid is if you collect prior to your full retirement age, but you're still working. A lot of people are working now past the age of 66, 67. And again, it may feel good to get some checks, but you don't understand what the net impact is to you. It's called the annual earnings test. If you apply for Social Security before full retirement age and you work, $1 in benefits will be withheld for every $2 you earn over $17,640. That's the threshold in 2019. You will get them back at some point starting in full retirement age when you do reach it, but it can mean that it could cost you thousands of dollars, and it may not be the right timing, again, costing you a lot of money during that early phase. The third mistake, the third trap to avoid, is that you might not be aware that Social Security is taxable. Let's take a look at the chart. And most of the people that I do work with fall, if you look at the married filing jointly, fall over the $44,000 mark. But what it's important to recognize and understand is that that is the provisional income for Social Security taxes. Now, provisional income is your adjusted gross income, your AGI, plus 1/2 of your Social Security benefit, plus any tax-exempt interest, typically municipal bond interest. And if those three numbers add up to more than $44,000, and that's what I typically see, then 85% of your Social Security will be taxed. If you're between $32,000 and $44,000 married and filing jointly, then only 50% of your Social Security benefit will be taxed. If you're single household, numbers are a little bit different. If it's over $34,000, then 85% of the Social Security benefit will be taxed. So make sure you're aware of that. Finally, I do have a number of widowed clients, and they ask all the time with regards to what their benefit is going to be. So we spent some time talking about this on a previous video, and I wanted to share with you specifically the answer to the question with regards to what's available for widows with regards to Social Security. Here are the rules for survivor benefits. The couple must have been married at least 9 months at the date of death. The survivor must be at least 60 for a reduced benefit, 50 if disabled. The survivor benefit is not available if the widow or widower remarries before age 60 or 50 for the disabled survivor, unless that marriage ends. And for a divorced spouse survivor benefit, the benefit is available if the marriage lasted at least 10 years. Now, there are 3 exemptions to this rule. 1, if you share a child. 2, if there was military service. And 3, if the death was accidental. Now, there are 2 key components to the survivor benefit that you need to understand. First, the benefit will depend on the age at which the deceased spouse originally claimed his benefit. Did he claim it early, at full retirement age, or did he delay it to age 70? The second key factor is the age at which the widow or widower claims the survivor benefit, whether or not she or he takes it early or at full retirement age. So let's go through an example here. Let's assume that Joe and Julie are married. Both are over full retirement age. Joe's benefit is $2,000. Julie's benefit is $1,200. Joe dies. Julie notifies Social Security and her $1,200 benefit is replaced by her $2,000 survivor benefit. Now let's take a look at the impact if Joe had taken his Social Security early and reduced his benefit from $2,000 down to $1,500, and then he passed. Well, if Julie claimed her survivor benefit at full retirement age, she would be eligible for $1,650. If she took it as early as age 60, she would get $1,430. Now let's take a look if Joe had taken his benefit later and delayed it to age 70. So his $2,000 benefit would have been $2,640, and then he passed. Julie's survivor benefit, if she claimed it early, would be $1,887, or if she claimed it at her full retirement age, it would be the full $2,640. So let me give you the summary. I know I've gone over a bunch of different numbers. The summary is if Joe had claimed it early, Julie's benefit at full retirement age would only be $1,650, or if she wanted it early, $1,430. Or in the other scenario, if Joe had claimed it at age 70 and then passed, Julie's full retirement age benefit would be $2,640, or an extra $1,000 a month. And even if she claimed it early, she'd have an extra $450 per month. So those are some of the answers to some of the big questions that we've gotten over the past few months. And I'm certainly happy to update on any more that I get for you as we produce more and more videos for you. If this was of value to you, make sure that you subscribe to our channel, and make sure that if you have an interest in getting more in-depth information, go to our next video.